Do we have a breakthrough in peace talks? From New York City this morning, good morning, good morning. Futures, like what they hear, up 0.8%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue, a change of tone. Peace talks in Turkey developing into something we haven't seen before throughout this devastating war. A more constructive tone from both sides. The Ukrainians indicating a Putin-Zelensky meeting is on the table. Russia echoing that positive sentiment, pledging to sharply cut back military activity near Kyiv. Team coverage starts right now with Bloomberg's Maria Tadeo in Berlin and Emily Wilkins down in D.C. Maria, put it all together for us, the view from both sides in the last hour.
Well, Jonathan, what I would say is this is the first time where we've had the Russian delegation and the Ukrainian delegation walk out of a meeting in which we get the impression that they actually sat the same meeting. Remember, previously it was a completely different conclusion from each side. Now we begin to see that there may be some shades of a compromise here. On the one hand, Russia says they are willing to pull back some of their military deployments to reduce them, especially around the capital. But I would say, and we need to stress this, at this point, the Ukrainian capital is completely locked, sealed. It's become a fortress city, so it would have been very hard to Russia to take the capital of Kyiv. Now, the other thing they also agree is that potentially there may be a meeting between Vladimir Putin and, of course, Volodymyr Zelensky. Remember, the Ukrainians had always said the only way we can put an end to this war is they actually sit face to face and have that conversation. Until now, as I'm sure you remember, Jonathan, the Russians always said we're not going to debate with Zelensky because he's an actor, he's a clown, he doesn't have the caliber for Vladimir Putin, and we only speak to the great powers of the world. But we're now seeing that potentially is also changing. And then thirdly, and this is also important, we begin to see detail. And that was the key in this meeting. What do we do with Crimea? What can happen with the Donbass? All of the big points of tension between the two countries are now finally being debated. So a lot of this can tell you this was a constructive meeting. The Turkish foreign minister who was there, remember, this is a country that's hosting the talks. He said, for the first time, I see progress. But of course, we need to see the reality on the ground. And this is not the first time the Russian Federation lies about the invasion, about its plans, about targeting civilians and not using, neighbor in Belarus. So a lot of this will have to be certified on the ground.
There is hope right now, and hope is all we have at the moment. Emily Wilkins, before we verify all of that, I understand President Biden will hold a call with European allies. What's the focus of that call?
A lot of the focus is going to be what Biden's tried to focus on from the beginning, really remaining together with allies, what, if anything, they need to do to further help Ukraine. You heard Ukrainian President Vladimir Zelensky go ahead and criticize the West for not doing enough, saying that they needed to have more weapons, more support. And you have seen some of those efforts actually stalled in Congress, things to end permanent normal trade relations with Russia passed the House, but now they've hit some roadblocks in the Senate. They haven't gotten to Biden's desk. At the same point, Biden is also going to have to deal with the fallout from his remarks over the weekend, saying that Putin should no longer be in power. We heard him address those remarks at length yesterday with reporters, saying that was a personal, emotional statement, that it was not a sign that the U.S. is changing its policy to Russia or calling for Putin to be removed. Still, that sent shockwaves around the world. We saw French President Emmanuel Macron say that, that they want to de-escalate, not escalate tensions. And you also saw the Kremlin respond to that, saying that it could impair discussions going forward. So I think one thing that Biden's certainly going to have to do today is some damage control with his European allies.
Maria, as you indicated, we've seen this happen a few times now. Some misplaced hope. It feels different this time around. And Maria, I'm wondering today in these talks, what changed? What changed for both sides as they sat around a table this time?
Well, I would say it's two things. One, for the Russian Federation, it is becoming clear that this is not going to be a war they can win on the ground. Now, they can bomb Ukraine, they can destroy Ukraine from the air, but on the ground, they face incredible resistance. The idea that they could just switch a government, put in a puppet instead of Zelensky, that is pretty clear at this point that that cannot happen. When you look at sustained occupation, it is also clear that the Russian Federation is not in a position to occupy Ukraine forever or to just make it another Belarus, a country that essentially becomes a satellite for the Russian Federation. The resistance on the ground, Jonathan, we've seen it for a month from the people of Ukraine. It is so big that for Russia, this is now an operation that is becoming very, very difficult. For the Ukrainians, of course, they see the state of their country. They now had a reality check about NATO. They know they're not going to be able to enter this alliance, and now they're looking for a plan B, for a way out that can end the war. So the two sides have a very strong incentive now to get to a ceasefire and, of course, try to find a diplomatic solution. But I would say, let's not get carried away. We've seen Russia promise a lot, but, of course, under-deliver. And a lot of the situation in Kyiv responds to a military failure of the Russian Federation. We also the images of that convoy that was approaching the capital of Ukraine, unable to take the capital of Ukraine, and Kyiv was a city that had become a fortress for the Ukrainian government. So maybe a lot of this, you could argue, also has to do with saving face for Russia.
Maria, thank you. Maria Tadao in Berlin, Emily Wilkins down in D.C. It looks like progress, and progress is what we want to see. Now we need to verify some of the things that are being promised. The pullback from Ukraine's capital, a severe drop, a sharp drop in military operations there from the Russian side. That's the hope, that we get a meeting between the two leaders and we secure some kind of ceasefire, at least at the minimum, and maybe even a peace accord. For the market, it picks things up like this. Dollar ruble, first week of March, was pushing a 180 handle. Right now, back down to 86, with a big move on the session as well. Work your way through crude, a sizable move in crude. WTI a little bit earlier this morning, a break of 100. Right now on WTI crude, a 99 handle. And work your way through the bond market too. Treasury yields were higher, now they're lower. We can talk about that in just a moment. But in Europe, a sell-off in the German debt market with the bund yield at the front end on a 2-year through zero, briefly, for the first time since 2014. What does this change for central banks worldwide, not just for the Federal Reserve, but for the ECB too? Let's get the panel and get to them now. Morgan Stanley, Sankaran, Pictet's Ella Hoxha, and Aaron Kennon of Clear Harbor Asset Management. Ella, I want to begin with you. What do these headlines change for you, the headlines from the past 24 hours and the headlines in the last 60 minutes?
Well, it probably focuses the bond market more with the Fed and what Powell's been guiding the market since last week. And we've certainly seen increased hawkishness there from the central bank. But, you know, our view is that bond markets had already appeased themselves to some extent from the initial shock of the war and the market reaction from that. You know, financial markets more broadly were expecting some backtracking or at least some softening on the tone that we've been hearing, at least for the past 3 to 4 weeks. So don't think it's a major surprise for the bond markets, and you can probably see from the reaction in the 10-year yields, sort of you would expect it to sell off on good news, but in this case, some of those good news were already priced, but it's also reacting more to the idea that perhaps we don't get this commodity shock that the markets were trying to price 3 to 4 weeks ago.
Sri, good morning to you. Your thoughts this morning, please.
Yeah, morning, John. So, I mean, any progress would be welcome on the humanitarian front, surely. And to the point made by the earlier speaker, from the market's perspective, I mean, the focus will definitely shift back to the central bank kind of hawkishness, whether it stays in place. Our view, still, we do think that there is probably a bit more of the hawkish surprise of the tone, which will continue. From the risk market perspective, I think that's where there's a bit more of a conundrum to be resolved. I mean, we were a little surprised by the magnitude of rally that we have seen across both equities and credit on the back of the hawkish pivot from the Fed, or the repivot from the Fed. I mean, I do think that that's probably something that is likely to fade over the near term as the magnitude of the rate hikes and the market starts to price in what that means with respect to the growth, the earnings outlook, and in general risk appetite.
The one bull market we have right now, I was told by Julian Emanuel of Evercore this morning, is in hawkishness. And Aaron, I wonder from your perspective whether you think we're picking up on that bull market and hawkishness from this Federal Reserve effectively, efficiently in the equity market.
Well, it's a great question. I know so many people are of the view that the Fed can sort of re-embrace what they said last week, which is that they'll start moving 50 basis points now that, you know, we're making progress in these negotiations. But I do think that there's the other side of the story, which is we had huge supply chain challenges going into the February 23rd war in Ukraine. And perhaps there's a view within the central bank community and within the economics community that we're going to see some of those supply chain bottlenecks subside if this progress in Ukraine is real. And it may actually allow central banks, particularly the Fed, to take a slightly more constructive, tightening, yes, approach, but maybe a slightly less hawkish approach throughout the course of 2022. And I think the data will, the timing of particularly this negotiation as it pertains to energy and as it pertains to soft commodities, particularly wheat, and those impacts on the overall economy could impact how central banks think about their policy going forward.
Aaron, just clarify that for me again. You think that what's developed this morning reduces the risk of an even bigger move from this Federal Reserve?
Yeah, so we had significant supply chain challenges. And if you look in the United States prior to the war, we're not hearing and talking about the Port of Long Beach. But if you look at the data there, for example, that is really, as more people have come back to the workforce at those ports, and the rail lines are running well, and the trucking business is starting to we see labor participation picking up in that segment of the market. We're seeing strong components of a thawing on the supply chain front. The war sort of put a halt to that commentary because we saw a spike in energy prices. We saw concerns around soft agricultural prices. And so there's sort of this thought that I had this morning, and you see the Treasury market rallying. I'm looking at it right now and not selling off. And perhaps it's a view that we'll start to actually see inflation if this conversation in Ukraine really is an indication of progress. We could start to see inflation thaw both home and abroad.
And we'll keep this conversation going alongside Ella and Sri, going into the opening bell about 20 minutes away with futures elevated. Just something for the diary this morning. We are expecting a news conference with Secretary Blinken with his Moroccan counterpart a little bit later. A first scheduled opportunity for the US administration to give their views on what's developed a little bit earlier this morning. Let's get you some movers ahead of the opening bell. Let's do that with Abby.
John, well, you mentioned that stocks are higher on this Russia-Ukraine optimism. Tech in particular outperforming. The Nasdaq 100 futures up more than 1%. Not surprisingly, big tech names are sharply higher. Apple, Microsoft, and Nvidia really leading the way up 2.7%. The travel trade is back on too. Delta Airlines as a representative flying high by about 3%, no pun intended. To the downside, though, not surprisingly, defense contractors lower. Lockheed Martin falling by about 2.9%. And with oil consolidating right around $100 per barrel, right now slightly below. Some of the big oil names are lower, including ExxonMobil, falling right now by about 2%, John.
Abby, thank you. Coming up on the programme, optimism emerging from peace talks out of Turkey, boosting risk assets and sending futures to session highs. That conversation up next.
We've said, Tina, for quite some time,
there are no alternatives to equities.
When you think about all the pressures in the world,
the geopolitical conflict that we're experiencing,
the Fed doubling down on being extremely hawkish.
Inflation that's around 8% and set to pick up closer to 9%.
It's going to be a wild ride.
Well, where do I go? Do you go into cash? Hell no.
With the inflation, cash looks toxic.
Do you go into bonds? Hell no.
The bonds look toxic.
You end up not reducing your allocation to equities, but actually looking to increase them.
There are few better places to put your money than the S&P and the NASDAQ.
This market has been all about inflation. It's been about the Fed. It's been about bond yields.
Equities overall are doing well.
I am very impressed and quite honestly surprised.
It's Tina. There is no alternative to U.S. equities.
It has been quite a month, hasn't it? The equity market doing pretty well, considering all the headwinds that it's facing, including in the bond market, with a two-year yield going from the end of this month at 143 through 240 this morning, and now at 234.65 on a two-year. What a run we've seen, and what have we heard? Tina's made a comeback. Katie Lyons, how many times have we heard that over the last few weeks?
I don't even think I could begin to count, John. And usually counting is what I do best. But to your point, it has been absolutely brutal for the bond market to the point where yields moving higher, not yet to the degree which they're more attractive relative to equities, which could, in theory, fare a little bit better. We have the global aggregate bond index down 7.3% year to date, heading for a record drawdown. Then you have the 10-year yield up 91 basis points here in the U.S. in just the course of 3 months, 80 basis points over in Germany. That's still, though, not quite at a level where they are more attractive relative to stocks. When you look at the equity risk premium for both Europe and the U.S., you can see the stock 600 earnings yield is still roughly 6 percentage points above that of the 10-year Bund. For the S&P 500 minus the 10-year Treasury, still looking at a gap of around 2 percentage points. Reinforces that Tina narrative we've been hearing so much about. That is, though, John, if you are putting money to work. But there is also a lot more on the sidelines in this moment. The last Bank of America Fund Manager survey showing a larger than normal cash position among respondents. Cash levels up to 5.9%, which was actually the same level of cash held at the start of the COVID rally in 2020. But in an inflationary environment where some say holding cash makes not a lot of sense, that firepower may need to find a home soon, and that could be in equities, John.
Kelly, it's an important distinction. Thank you. Ella Hoxha, if you told me at the start of the month we'd have an almost 100 basis point move on the front end of the Treasury curve, I would have thought we'd be talking less about Tina and not more about Tina. There is an alternative. Why aren't we doing that then, Ella?
I guess it's been very much led by the Fed in terms of the front-end move. Initially, we started the year with the idea that, yes, inflation was going to come down halfway through the year, and yes, growth was going to be above trend, but much lower than what we saw last year. So broadly, sort of the kind of backdrop where your forward yield forecasts by the strategists in the street were not at all hawkish. So you're absolutely right. This 100 pips move in the front end has been a surprise to most bond market participants. Where do you go from here? It's tricky because the setup from a macro perspective in the U.S. supports, and the inflation backdrop in the U.S. supports the Fed actually pulling rates higher. So it's very difficult to argue against that. And that's why you're seeing most of the macro players, such as ourselves, actually playing the curve. So, looking for that flattening theme in the curve, which is something that we've been calling for since last year. The argument here is, can that stop? And that can stop if the front end stops selling off. And right now, we just don't have enough to tell us otherwise. So this theme of inversion continues. But, having said that, positions in the markets are fairly stretched to that view. And we are very vulnerable here to any potential surprises, as the previous speaker was alluding to, say, on the inflation side. But it is a risk rather than your base case. Your base case here is still not a pretty one, more broadly for duration and rates.
And the thing I hear is that 250 doesn't get it done. That doesn't get it done in a world of close to 8% CPI. And real rates are still negative. And this is what Goldman said this morning. Real yields are still providing some buffer against further real rates increases because real yields are negative. Aaron, does that resonate with you as well?
Yeah, I mean, I do think that there's, that makes some sense. But, if you look back at sort of the pre-COVID charts, now we had a different inflationary picture, but we had in 2018 nominal yields around 3%, and the curve was flat. In the fall of 18, we had twos at about 3%, tens close to to that sort of level. And it wouldn't surprise me if we sort of returned back there, but it doesn't take away from the fact that the inflationary picture in 2023, if things break as we suspect they may, could improve dramatically. And you look at TIPS break-evens, you look at the five-year forward fixed to floating level, long-term inflation expectations are still reasonably well anchored. And lastly, I would just argue, too, that our debt to GDP has trended from that 2018 period from 100% of debt to GDP to about 135%. The Fed knows that. The Treasury knows that. Higher interest rates in terms of the interest that we pay on our deficit becomes unsustainable for the U.S. government. And I believe that there's a natural realization, and that's going to probably, again, force the Fed to remain, yes, incrementally hawkish, but perhaps not as extremely hawkish as many are predicting, which is 2 and 3 50 basis point moves this year with a couple of additional 25s. I think the front end of the curve is sort of attractive here because I think the Fed may, in fact, raise rates and overshoot, and then we end up seeing them cut rates next year.
Next year? I mean, I've heard that argument a few times, that perhaps there's something about this that is self-limiting because the amount of debt both on the corporate side as well as the sovereign. This just came in from Jonathan Golub, Credit Suisse, and he basically said the following. The Fed's projected path of rate hikes will not be enough to tame inflation. Put differently, not only is the rate too low today, but it will likely be too low even after the Fed completes its projected rate hikes. Stay with stocks. I mean, how many times have we heard that, Sri? Is the same true of the credit market from your perspective, from where you stand as well, Sri?
I mean, credit obviously is slightly different in the sense that there is a technical valuation argument that comes in from what the Fed is doing, et cetera. But there is also the dynamic of how it feeds through into fundamentals, sort of what Aaron mentioned with respect to the government bond market, right? But I think the tension here within credit, I would say that by and large, if it's just about rate hikes into a relatively healthy economy, and earnings growth holding in positive territory or reasonably in positive territory, that's still a story that credit markets can absorb, i.e. corporate balance sheets are healthy enough to absorb the magnitude of rate hikes that the market is forecasting or our economists are forecasting. But the working assumption has to be that earnings still hold up. I think if the second leg of the argument starts to fall apart, that's when we start getting more concerned about the ability of corporates to service debt in a higher interest rate environment.
Let's regroup and talk about that last leg. I think that's the important piece around the equity market open as well. Sri Sankaran, Ella Hoxha and Aaron Kennon. If you're just tuning in on Bloomberg TV and on Bloomberg Radio going into the opening bell, a constructive tone from Ukraine and Russia out of talks in Turkey today. Futures pushing higher. Up next, the morning calls, and later, 10 days of gains, adding more than $400 billion in market cap for one single name, Apple. That's just around the corner. 5 minutes away from the opening bell, a constructive tone between Russia and Ukraine sending equities higher. That's the price action here at the morning calls. First up, Deutsche Bank downgrading CVS to hold 110 price target, pointing to the stock's negative risk-reward profile amid rising risks. Morgan Stanley downgrading Pinterest to equal weight, $30 price target, seeing multiple headwinds, creating too much uncertainty. And finally, Argus upgrading AutoZone to buy, highlighting multiple near-term growth drivers. That stock negative 0.4%. Up next, Apple on track for its longest winning streak in almost 2 decades. That conversation up next. "24 seconds away from the opening bell this morning. Good morning. This is what we wanted to hear. A constructive tone from both Russia and the Ukraine coming out of talks in Turkey, and those talks will continue into this evening and into tonight potentially as well. Off the back of that, equity futures elevated on the S&P by 0.9% after a 3-day winning streak. Can we make it 4? Switch on the board and get to the commodity market. A break of 100 on crude. 99.55, down 6 percentage points off the back of this story. A dollar that's weaker, a euro that's stronger, unlocking a conversation about ECB rate action later this year. Higher bond yields, a stronger euro, 111.27. And if you can explain this one for me, go ahead. There's got to be a head scratcher in the mix as well, hasn't there? 242 on 10, yields in 4 basis points, and for some reason a bid back into treasuries off the back of all of this. That's the cross-asset price action. We're up 0.8% at the open, about 30 seconds in. Energy, as you would expect, is lagging down 1.3%. Consumer discretionary up by 1.2%. With your movers, here's Abby.
John, well, on this very strong start for stocks this morning, it's a broad-based rally on this optimism over Russia, Ukraine, the possibility of talks. Microsoft, one of the top leaders, up 0.9%, really helping out that tech sector. Interestingly, even though yields are down just slightly, banks higher. Citigroup, one example, up 1.8%. American Airlines up 4.1%. This, of course, is the travel trade rebounds on the thought that peace between these two countries could help international travel. And then finally, General Motors also in on the game, up 3.5%. Again, a very broad-based rally. To your point, John, energy is that lagging sector.
Abby, thank you. The one name to watch is Apple. Through yesterday's close, a 10-day winning streak. That was the longest winning streak since 2010 for this single name. Now it is 11. 11 straight days of gains and adding almost 18 percentage points to that name. The team here at Bloomberg crunching the numbers over the previous 10 days. That's a market cap move of more than $400 billion. And if you want a comparison, that's roughly the same market cap as Walmart. Bloomberg's Ed Ludlow joins us now for more. Ed, what a stunning rally.
Good morning, John. We're up 0.9%, right, on Apple. We're on the verge of $3 trillion market cap. It's an astonishing story, right, especially when you consider the backdrop of yields, what's happening in Ukraine, the questions around demand. I'm also looking at Amazon, by the way, which is higher because Amazon is the leader of the mega caps on a year-to-date basis. But come with me straight to my Bloomberg terminal and let's talk about this run. If we close higher, as you said, best run since 2003. If we close higher on Wednesday, we match that 2003 run. If we close higher on Thursday, which would be 13 consecutive days of gains, then it would be the longest winning streak in history. And that's interesting, right? You see analysts boosting earnings estimates by around 7% for the year for Apple. They kind of shrugged off the stock, that report by Nikkei, that they'd cut production by 20% on the base model iPhone SE because of waning demand due to inflation and the conflict in Ukraine. What stops this stock? There is a warning in this chart, John, because, of course, the last time Apple hit $3 trillion at the beginning of the year, the S&P had a significant drop to follow. We also have yields at 2.5%, right, on the benchmark 10-year Treasury. Apple is not immune from the conversation around higher rates discounting the present value of future earnings. But why is it not immune? It's really interesting narrative. And then we talk about what investors are doing right now. The NASDAQ 100 is still down 7% year to date, but there seems to be this move into quality and growth names. I talked about Amazon being the year-to-date leader of the mega caps, up 2.5% so far in 2022. That seems to be on the back of their own stock split, right, which has given retail investors a reason maybe to look at Amazon, some enthusiasm. Apple almost positive year to date. We're so close, John, but it's really interesting given the backdrop.
Ed, the move in Amazon, never mind the year-to-date move, it's a 25% move off the lows of March. Are you telling me that's just about a stock split?
No, you know, again, just as Apple has done with the consumer product and shown resiliency with the supply chain, Amazon has shown that it is the sum of its parts, right? If there's a slowdown in the .com business, then the AWS cloud business has come in based on recent earnings from prior quarters to save the day. It is a profit machine. And what's really interesting is that there's confidence from Wall Street, even with everything that's going on in the world of consumer, even the inflation story that's going on and higher input costs for companies. Amazon still seems to be able to grow that top and bottom line.
Ed Ludlow, thank you. Ed, looking forward to the coverage for the next couple of weeks. What a rally we've seen in these big names. Ella Hoxha, I want to come to you on that, actually. Just the moves we've seen in Apple, in Amazon off the lows, in Tesla as well. What do you think's behind all of that?
Well, the relief, I suppose, on the more positive developments from at least on the Ukraine front. But more broadly speaking, the scenario that equity markets are pricing, which is a little different to bond markets, I suppose, is one where growth is okay. And, you know, as you see the beginning of tightening policy from central banks, particularly the Fed in this case, equities tend to do okay. So despite all the rhetoric that you hear on the 2/10 U.S. Treasuries curve flattening, historically speaking, equities have performed well on that. So it's much more aligned with the idea that we're not in a late stage of the cycle, right? So it depends which school you sit with. So if you're in the late stage school, then probably this should be the last innings of the move. And you know, the volatility that we see in rates markets, which is very elevated still, is actually giving you one of those signals, as is your sort of more classical recession story from the curve flattening. But really, there's a bit of a dichotomy there going on between what bond markets are saying and what equity markets are saying at the moment. So equities are playing with a hope and the better growth scenario, and bonds are getting more worried, say, a year or so down the line.
Sri, you talked about the importance of earnings. Let me share this quote from Citi with you. They said Fed funds have little correlation to the S&P 500 price action. They go on to say, while a modestly negative correlation to multiples is notable, the more interesting attribute is a notable positive correlation to S&P 500 earnings. They conclude by saying this reinforces our emphasis on earnings growth drivers as the key to equity market performance in the intermediate term. So, Sri, let's pick up on that dynamic of earnings. For you, has the outlook for earnings got better or worse since this year started?
Yeah, I'm just going to borrow the thoughts from my equity colleague, Mike Wilson here. We do think that the outlook is weaker. And more specifically, when we look at the nature of the earnings revisions that have come through, the point that Mike has been making in recent weeks has been Well, you've seen the downward revision come through in the near quarter earnings, but obviously some payback in the later quarter earnings. That's typically not a healthy sign. That kind of resonates almost with the transient inflation narrative, where we're saying, well, it's going to be bad for the near term, but then it improves very meaningfully. We're not in that camp. I mean, but at the same time, we don't think that this is the bond market signaling recession risk. But for the perspective of earnings, it does feel like we are going to be pricing in a weaker earnings outlook rather than a stronger one.
How would you price that through Credit Suisse?
A bit more of decompression is what we want to see within the credit markets. What's been most surprising has been our call has been default risk over duration risk. That's played out well. But at the same time, it does feel like the more recent narrative around the next leg of the rate hikes being more significant and more front loaded, that should really trigger a bit more of concerns around the lower quality portions of the market where the sensitivity to earnings is going to be higher. And at the same time, the impact of higher rates is also going to be more meaningful. So that's kind of why I do think that the more floating rate dependent capital structures plus lower quality companies, those are where we do think more cracks are likely to show up within the credit markets rather than a broad-based sell-off.
It's three high yield has looked really insulated given what's happening in the world, around the world in the last month or so, but insulated because of the sector mix, so heavily tilted, weighted towards energy. If we do indeed get a de-escalation, and I don't expect you to provide a forecast there, I just want to understand the dynamic, the reaction more broadly in high yield. If you get a de-escalation and energy just kind of backs off a bit, does that leave high yield a bit more exposed?
I mean, to some extent, yes, but at the same time, a lot of the correction year to date has been in the higher quality BB, longer duration pocket, which to some extent is likely going to be a beneficiary of that move. So arguably, yeah, I mean, to some extent, the sector mix hurts the high yield market if we do come off the boil with respect to the geopolitical tension. But at the same time, some of the longer duration, higher quality pockets within high yield are probably going to hold up better.
I just quickly brought up the research from over the weekend from Mike Wilson over at Morgan Stanley. And Aaron Kennon, I'd love your view on it too. Markets priced for a tighter Fed, but not for growth risks. The view of Mike. We're downgrading financials to neutral, given a more late cycle view and forecast for a full inversion of the yield curve in 2Q. 2Q starts this week into next week. Financials will have a hard time outperforming. That's the view from Mike. And let's go with the first line, Aaron. Markets priced for a tighter Fed, but not for the growth risks. Does that make sense to you?
Yeah, I think it does, and that's sort of our base case, in fact, which is, you know, the flattening of the yield curve historically augurs or tends to be a signal of heightened recessionary risk. But this time around, because of the unconventional nature of monetary policy, we think that signaling is a bit muddy, and that we may, in fact, experience not a soft landing, but something between a hard and a soft landing, and may just, in fact, avoid that recessionary concern. But I have to go back to the reality that we have disposable, our savings rate is lower. We still have the inflationary pressures weighing on key segments of the equity market. Our expectations are that, earnings are going to disappoint, that we're going to certainly see a significant deceleration of the growth picture this year, and that the Fed is going to, clearly hike rates and hike rates somewhat aggressively. But we think as we move into the back half of this year, as a result of that, the Fed put is going to come back into play, and that could be positive for equities as we move into the back half of the year and into 2023.
How much lower does inflation need to be at the back end of this year for a Fed put to come into play?
It's a good question. We'll have to see how this all plays out. I suspect it'll be a Q4 sort of event. There's a lot going on the geopolitical front that we're monitoring, and the wage picture here in the U.S. is certainly becoming more of a stickier point. So we've been humbled many times by markets. We do think the trend is for inflation to peak here over the next month or two and to trend lower. And we'll have to see how all that plays out, Jonathan.
I'm humbled every day by markets, Aaron. You're not alone. Aaron Kennon there, alongside Ella Hoxha and Sri Sankaran as well. About 11 minutes into this, equities up by 0.8%. Energy pulling back, down by 2.9%, now down by 3 percentage points as crude pulls back. A break of 100, a 99 handle early this morning on WTI, as we had a breakthrough of sorts between Ukraine and Russia in talks in Turkey, and those talks will continue through this evening. For the President of the United States, the focus will be on those talks, but also Things here at home as well, unveiling his $5.8 trillion budget proposal.
This year we're on track to cut the deficit by more than $1.3 trillion. That would be the largest one-year reduction in the deficit in U.S. history.
That conversation up next.
A firefighter and a teacher pay more than double the tax rate that a billionaire pays. That's not right. That's not fair. And my budget contains a billionaire minimum tax because of that.
The President of the United States there. Happening right now, Secretary Blinken in a news conference alongside his Moroccan counterpart. The first opportunity for the U.S. administration to respond to what we heard earlier this morning. Earlier this morning, of course, a constructive tone coming out of talks between Ukraine and Russia. Ukraine talking up the prospect of the two leaders meeting. Russia talking up the prospect of sharply cutting military operations in and around Ukraine's capital. The dates for the next set of talks not made just yet. This is what we hear from a source close to the Russian delegation commenting on these Ukraine talks. No date, place set yet for the next round of Russia-Ukraine talks. The delegation is leaving Istanbul now after those talks with Ukraine earlier today in Turkey. When we get the headlines from Secretary Blinken, of course, if they're pertinent, if they speak to this story, I'll bring them to you. For the President of the United States, for President Biden, his multi-trillion-dollar budget proposal running into opposition from key Senator Joe Manchin, calling the tax on unrealized capital gains, quote, a tough one. You can't be taxed on things you don't have. There are other ways for people to pay their fair share. Bloomberg's Joe Matthew joins us now from Washington with more. And Joe, I asked this of you this morning, and it's important. Do they want to make policy, or do they want something to campaign on?
Well, it's feeling a lot more like the latter, Jonathan, simply because we've already done this. With regard to the tax on unrealized gains, that was part of the Build Back Better plan that never got its way through Congress late last year. It failed. It was put on the shelf and it was left to die because lawmakers like Joe Manchin don't have time for this. He's not alone either, by the way. Kyrsten Sinema, who you remember looming large in that Build Back Better debate, also has problems with this reportedly. Even the chair of the House Ways and Means Committee, Richard Neal, prefers a different approach when it comes to taxing the wealthiest Americans. This would apply, by the way, to families, households worth $100 million or more. And it's pretty unclear exactly how this unrealized gain tax would be enforced. The issue here, Jonathan, is that one of the hallmarks of this budget, as the president outlined yesterday, was the fact that it was going to reduce the deficit. It would lower deficit spending by $1 trillion. But without that tax on unrealized gains, you can't get that $1 trillion. So there are things that need to be worked out here. By the way, we'll begin officially the process here next hour when the director of OMB testifies before the House Budget Committee. So here we go.
Joe, there's nothing original, as you know, as we all know, about American budgets coming out of the White House that never actually see the light of day. Here's another one. What I don't understand, though, is if you want to get something done, why aren't we having a conversation with Senator Manchin saying, what can we do? Because most people agree with the President of the United States here. Let's get people to pay their fair share. Whispering it down the microphone and coming up with things that won't pass and your own Democratic senator won't agree on doesn't get anything done.
Well, maybe you're getting a little bit closer to your first question, which is no one actually thinks it's going to get done. Look, this is supposed to be a projection or a statement of values, right? The most overused phrase in Washington yesterday. This is it's a laundry list. It's what we believe in. It's almost a campaign speech, if you think of it that way, knowing the White House knows all too well that this will be twisted into a lot of different pretzel pieces before this ever becomes a law. Reminding you, we just passed, lawmakers, 2 weeks ago, the budget, the omnibus budget that we're now operating under. This is halfway through the fiscal year. So if we think this is going to get done before the next fiscal year, that in itself would be an achievement. After that, about a month later, midterm elections. So it's not likely that this is going to see the light of day in its current form.
Hey, Joe. Thank you, buddy. It's good to catch up. Joe Matthew, looking forward to Sound On Bloomberg Radio, Mondays to Fridays at 5 p.m. Eastern Time. We've been watching Apple. A 10-day winning streak becomes 11, and now that 11-day winning streak on Apple erases the losses for the year. Apple's stock right now up by more than 1%, the longest winning streak going back to the early 2000s, 2003 to be precise. For a look at some of the names associated with President Biden's budget request, let's get to Taylor Riggs. Hey, Taylor.
John, I just wanted to debate with you instead some of the unrealized gains and how we do mark-to-market accounting on that. But we'll save that for another day. Let's take a look at some of the movers, of course, on the back of some of those budget proposals. I want to first start with some of the biggest increases, right, on sort of a year-over-year basis. We've talked a lot about defense spending on the back of some of the comments about Russia and Ukraine. On the domestic front, a big 32% increase year-over-year for some of the Veterans Affairs, $82 billion, a 27% jump for Health and Human Services. Commerce also a big gainer, asking for a 31% increase on a year-over-year basis. Let's get back to some of that defense spending, because what's so interesting is they're asking for a 4% nominal increase, 1.5% real growth. But a lot of people and Republicans have come out and said, no, we need 5% real growth. When you think about sort of the inflationary impacts on this sector, Northrop Grumman going to be a big one here, a new B-21 bomber. When we think about some of the nuclear modernization budget, of course, going to that, and a big $130 billion for R&D. That's within the Pentagon's budget as well. Flip up the board. Let's also just take a look at some of the transportation as well, because the Federal Transit Administration now going to get an additional $21 billion here. Of course, I should say 21, an additional $8 billion. Big money, John, for passenger and freight rail. And yes, ports, as we think about how to modernize those ports, and the big focus here that has been on supply chains.
Do you want to do the accounting thing now? We
Maybe
can always
in the
give you some
commercial
time.
break.
In the
How about
commercial break.
that?
I look forward to getting your
And then
personal
do I
views.
get like an unrealized rebate if there's losses?
I have no idea how this is meant to work, but isn't that the point, Taylor? It doesn't get done. You talk about doing something, you please someone, you don't make policy. Politics. It frustrates us both, I know. Taylor Riggs, thank you. Looking forward to the commercial break with Taylor, just moments away. Before we get there, let's get you some sector price action with Abby.
John, well, with the S&P 500 up for a fourth day in a row, up about 0.7% right now. Not surprisingly, most sectors are higher, being led at this point by consumer discretionary, up 1.2%. Think Tesla, Amazon, and the like. Technology right behind it, up 1.1%. NVIDIA, Apple, Microsoft. Communication services also higher. Think Facebook, Google, and Twitter. On the bottom, not surprisingly, it is energy. So there's a risk-on mood here on these, the optimism around the possibility of the Russia-Ukraine talks. There's also optimism for the travel trade. Airlines, similar to so many individual stocks, now higher on the year, up about 5%. And it's interesting, John, at this point, the S&P 500 up more than 12% from its February low, and now down just 4% below from its all-time peak. Let's see, are we going to put another all-time high? It seems as though that risk-on mood is here.
Abby, thank you. Thank you very much. Just working through some of the bond market price action too. 10-year yields in Germany just fading a bit, still up 4 basis points. Let's call it 61. We were positive on a nominal yield on a German 2-year a little bit earlier, above 0. Now negative again by 7 basis points or something like that. Positive about 6 on the session. The Treasury market has flipped. Yields were higher across the curve on 2s, on 10s, much more so on 2s, so the curve was flatter. The spread between the two was narrower. And now yields are lower across the curve, but lower on 10s than they are on 2s, so you can do the maths quickly. The curve is flatter and the spread still narrower. So the curve is still in single digits on 2s, 10s, 6 basis points, the difference between the two right now. That's the bond market. Let's get you to your trading diary on a better day for Ukraine-Russia talks and a better day for this equity market. Again, from New York, this is Bloomberg. 25 minutes in, we add some weight to this equity market. It's what we all want to see. An improvement between Ukraine and Russia in talks. Will it stick? And can we verify that pullback that the Russians are promising at the moment? The talks will continue on a date yet to be decided, but a constructive tone lifts this equity market on the S&P 4,600, on the S&P 500, advancing about 0.7%. Outperformance on the small caps, the Nasdaq up about 1 full percentage point. That's the price action. Here's your trading diary. The President of the United States holding a news conference with the Prime Minister of Singapore at 12:45 Eastern. More Fed speak. Hoxha, Bostic later this afternoon. More data coming up on Wednesday and Thursday too, with initial jobless claims just around the corner. And on Friday, it is payrolls Friday. The estimate so far, 490K. For the month of March. From New York, this was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.